What's going on, guys? Welcome back. So in this video, I'm going to be talking about something I don't talk about too much here on the channel, and it's a relatively new topic for me to be discussing it. But that's what my mind's been going in over the past couple of months, and it's the thing that I'm really going to be focusing on from here on out, so I figured I might as well start sharing it with you guys, and that is investing for cash flow through dividend-paying stocks. Now, I'm sure a lot of you, from judging from what you guys have said in the comment section down below, a lot of you guys love looking for good dividend stocks. But for those of you that, kind of prescribe to the way I had been, say the past 5 years up until this past year, you kind of look at dividend stocks and you're very indifferent with adding that into your portfolio. You don't really care one way or another whether or not your company pays a dividend. And if anything, you just want to be, full growth and get explosive 30+% returns like I was, because you think that that's going to be the best way to generate wealth for you over the long term. And I'm just going to be sharing my perspective on, why I no longer prescribe to that exact mentality, how I'm positioning myself accordingly, and then also, kind of putting it into a longer term perspective. Like, what is the best way for me to meet my objective goal of, generating wealth, whether it's through my job, investments, and, just utilizing my time properly. So I'm going to be talking about why I'm personally, explaining why I've been personally going down this road over the past year. And then hopefully you guys can get some good insights from that. And hopefully you guys can start to look into different things and look at it from a different lens based off of what I've been going through. Because after all, that's what this whole channel is about, is just sharing my journey here. And then hopefully you guys get a different perspective on what's going on. So to bring things back, so for those of you that have been following me for over a year now, when I launched this portfolio, I took a roughly exclusively growth investing type of portfolio and decided I really need to diversify my risk allocation. And I need to incorporate more stable businesses, and mainly businesses that are going to be cash flowing businesses for me. And so that way I can supplement my portfolio returns with dividends, not just with, sheer market cap growth. And a lot of that was due to the fact that I saw a lot of issues on the horizon with global growth. I kind of looked at it and it was like, okay, the way that I've been investing and the types of companies I've been invested in, they're going to be hurting over the next 5 years. And I believed that if I stayed with that same strategy, my days of getting, a 30+% return each year was going to be numbered. I definitely didn't think that I was still going to be getting, say a 22% this year, a 27 next year, 35 that year. Just looking at the way I see it and looking at how the landscape's changing and with how richly valued the overall market is, I just personally don't see that happening. And now, I'm sure you guys have also noticed that I am not the only one that's kind of, singing this tune. Over the past few months, it seems like every YouTuber, analyst, or, news journal seems to be stressing the importance of dividends and cash flows in your portfolio. And I believe a lot of that has to do with the overall risk that is essentially not being priced into the market, in my opinion. The amount of risk, obviously there's always risk in the stock market, but recently there have been so many, geopolitical issues, health-related issues, just so many issues that are going on in all different facets of the stock market, yet the stock market is still hitting all-time highs. And then you have the Fed acting kind of weird with just cutting interest rates again today with a stock market that is hitting all-time highs. It doesn't really make a lot of sense. At least in my opinion. So a lot of people have been more so deciding to, okay, let me take a step back from growth and let me go to more quote-unquote safe investments. Now, personally, I can agree with most people saying that the S&P, on a broad scale of things, especially when you take in the kind of risk that's going on, is kind of overvalued. If you take a look here, the Shiller PE ratio is at a 30. Now, the Shiller PE ratio, as you can see here, is it's adjusted for inflation and then other cyclically adjusted measurements, aka the CAPE ratio. So you take a look at that, and we're essentially double what we are historically, with the median being about just under 16. Or you can look at the regular PE ratio, and it's at a 22.3, which is still historically high. So, just on that very quick look of things, the stock market in general is anywhere between, fairly valued to overly valued. You know, there's not really, you know, like, there's definitely not a lot of panic going on in the streets right now, even though that seems to be what everybody's talking about. Everybody seems to be talking about, oh, a recession could be right around the corner, but not many people seem to really be pricing that into the stock market. So I thought that was kind of interesting. Now, I do want to stress that looking at the market and saying like, okay, it seems pretty expensive right now, probably isn't the time where you want to just say, okay, I want to sell all of my things and go straight into cash. And that way I'll just wait for the correction. If things are overvalued, it's only going to be going downhill from here. And I think we all know that attempting to do that is a fool's game. Timing the market is a utter fool's game, and generally you're going to waste more money attempting to do it than you're going to save. You know, no one can do it properly. You know, you might get lucky, you might nail it once, but no one does it right multiple times. So in my opinion, it's just a lot of wasted brain effort if you're going to be attempting to, you know, say go all in stocks and go all out of stocks because you have a hunch on that this is the top or this is the bottom of the market. And so I definitely don't want to come across as saying that I'm attempting to time the market right now. I just personally think that between, you know, looking at the stock market, it's still pretty richly valued in my opinion. There aren't a lot of great deals going on for the companies that I had been invested in for a long time. And there's also a lot of risk. I just figured I needed to switch, you know, what type of strategy I was using with my portfolio. Because, again, I'm fairly young. You know, I'm 22. I have a long time period. You know, we could hit a recession tomorrow, and in all honesty, you know, my portfolio would not really affect my life in the slightest. So, you know, my hedge against all of that and my hedge against time is just staying in the market through thick and thin. I never want to be someone that's, say, more than 60% or say more than 40% in cash at any point in time, regardless of how overvalued or undervalued I think things are. I think most of my money that, you know, it's free in investing, obviously, should be in equities at any point in time. Now, I also going back to the whole dividend thing and, you know, kind of saying like, okay, well, if you assume that they're, you know, things are slowing down, things are, you know, not properly, you know, justifiable in terms of their valuation, why are you approaching dividends? And that is because dividends throughout history have been shown to be one of the key factors to generating wealth over a long period of time. Now, as you can see here from this graph that was provided by Hartford Funds, really cool article, I'll link to it down in the description below, and it kind of spells out for you in black and white like exactly what happens if you reinvest dividends or if you do not reinvest dividends. So right here you can see the growth of $10,000 from 1960 to 2018. And, you know, you essentially get 5 times more your money if you just reinvest your dividends. So right here, 82% of all of your total returns from the S&P index were because of reinvesting dividends and allowing that to compound. And now I know for a fact, and you guys probably also know this, that beating out the S&P 500 for, you know, roughly 80 years is probably not going, probably for 60 years is probably not going to happen. So my bet is that that is as good of a return as you could probably get with just about any type of asset class. And 82% of that return coming from just reinvesting your dividends is something definitely to keep in note. You know, depending on what time frame you're using, if you use a 40-year, you know, time frame, a 30-year, or whatever it seems to be, a lot of total money in the stock market seems to be from getting dividends from companies and reinvesting it. I can actually come down here into the chart, and you can actually see, depending on what decade you're looking at, how much of the total stock market returns were due to dividend reinvestment. So, you know, look in the 40s, 67%, 50s, 30%, 60s, 44%, 70s, 73%. Can you believe that? 2000s, dividends were kind of, it says right here, the dividend index was negative. That's kind of, well, the total return, including the dividends, were negative in the 2000s. So, you know, it's a bit of a wash. You can't really save that. And then, you know, in recently in 2010s, it's been 20%. So obviously dividends will always play a big role, or have always played a big role in, you know, investor returns. Now, for the average investor, this is kind of something I think you should pay attention to, or at least look more into. And, you know, if you take a look at the macro situation with what's going on here, you spell out a couple of things that kind of mean, okay, maybe it's time I look for cash flow. You know, you take a look at, say here, which is a really cool chart. you look at all the PEG ratios across all indexes. They all seem to be pretty high, at least, you know, in terms of relative value to what they have been in the past. So you have this, you have the PE ratio at an all-time high, you have the overall market's PEG ratio at, you know, between a 1.2 and a 1.5. So a significant amount of future growth, even in the broad market, is already priced in. And that's something that is worrying to me, especially if you are/were a, you know, pure growth investor. You know, I kind of had to look at it from my own personal perspective. Like right now, do I want to be heavy in growth currently, or would I rather, you know, take a step back, let my money stay in the stock market? I'm not going to sell out of my growth names that I have, obviously. The ones that I have put my money into, such as like Facebook, Intel, other names like that, I think that they're just going to perform really well over the long term. And I'm not going to deal trying to, you know exactly, okay, this is the top for this cycle for this company. I'm not going to try to take that approach, but I'm not going to spend a lot of time stretching valuations and stretching my estimates for companies that are already very richly valued. And that's pretty far and few between, finding value in those types of companies currently. And so then I take a look at my, you know, personal situation. And for those of you that are in my age bracket, you might be following into a very similar age type of situation. So I kind of want you to keep that in mind. Is that you have to realize, like, I am a student first and foremost. So I'm 22. I'm finishing up my degree. I have a dual concentration in finance and information systems. So that's a lot of work, whether it's on, you know, coding databases or, you know, just investing in general. I am one of the founders of a tech startup that I have been spending countless hours recently, you know, raising money, fundraising money, working on the business model, getting the prototype out, all that stuff. You know, that's been a lot of work. I run this YouTube channel. And then I also currently have a co-op with a asset manager in Boston, and I have a 2 commute both ways when I'm doing that. And, you know, it's there's a lot on my plate. And so the way I look at it is I no longer have the ability to spend 40 to 60 hours a week just analyzing a select few amount of companies and expect to generate between a 20 and a 30% return. And I think that anybody that is able to spend, you know, anybody who's able to spend their entire week studying stocks, I definitely think that, you know, you don't care what the heck the market's doing right now. I think you will know before I do, before most people do. If you have that much dedication to the stock market, you're going to know exactly when or when not you should be buying a stock or not, in my opinion, at least the majority of the time. Obviously, not all the time, but I digress. You know, but I just kind of look at it, and I'm no longer able to put in that amount of time. It was great, and now that I'm making a little bit more money, if I could still generate between 20 and 30% a year, that would be great to compound my wealth. However, I have to look at the opportunity cost of my time, and then also the odds in our current economic environment. Am I actually going to generate the 20 to 30% returns? And I just don't think that's the case. So I think, you know, switching to a more, you know, at least for my new money that I deploy, to a more passive investment style, you know, I want that passive income that's going to grow with me over the long period of time, is just going to service me a lot more. And so now, once I decide I can buy a company, say like Starbucks, for example, when I look at Starbucks now, I only have to look at Starbucks for a couple hours every quarter, and I'm going to know what's going on with the business. It's a pretty boring business. There's not a lot going on with it. It sells coffee. I know a lot of people talk about, you know, all the tech innovation that they have going on. But, you know, at the end of the day, they sell coffee. That's what they do. They're expanding in China. Be whoop-de-doo. You know, you want to look at those numbers. But at the end of the day, I don't have to worry about, you know, someone radically taking away 30% of Starbucks market share because they made a better cup of coffee. Like, you know, that just isn't the case. And, you know, those are the types of investments that are much more attractive to me right now, because it means that I can still do everything that's on my plate while making my money still work for me in the back end. So that's just kind of the direction I'm probably going to be taking this channel, at least for the short term, you know, say over the next couple of years until I'm out of college and everything's, or until the market, you know, kind of regulates itself. One or the other, whichever one happens first. But I wanted to just kind of shed light onto why I have been structuring my portfolio this way. Because I know a lot of you guys are kind of worried about, or wondering, like, okay, why the heck are you buying Facebook and Altria. Like, those are generally not things that you buy together. You know, those are weird type of investments to kind of lump together. And, you know, I'm obviously not getting explosive returns. Like, you know, I'm beating out the market by, you know, about 8%, which is nice, but it's not anything to really brag about. You know, 12% return is definitely good. And, you know, this might be a lot of hubris talking, but I feel like I can do a lot better if I was playing the riskier game, but I don't have that risk tolerance currently, and I also don't have the time to service that risk tolerance right now. So that's just kind of why I've been taking this approach. And I'm interested to hear from you guys. You know, a lot of you guys have talked to me about, like, oh, I like this stock, it pays a dividend, or I don't like this stock because it pays a dividend. So I want to know, like, what are your guys' plans for generating cash flow? Do you plan on doing it through dividends, or do you plan on doing it through, say, real estate, or do you just plan on making all of your income, you know, through active, you know, time that you put in, you immediately get income out, but you're going to get a really high service skill that you're going to, you know, really robustly refine, so that way, you know, 1 hour is worth a significant amount of dollars. Like, so I'm pretty interested to see what your guys' approach to generating wealth is over the long term, and also just kind of give you this update as to an explanation as to why the heck I've been managing my, you know, channel portfolio this way. So thank you guys for watching. I know that this was kind of more of just a rambling video, and forgive me if this is pretty boring, but I just figured that this was a lot of stuff I needed to get out there and talk about, and I know that this isn't like a real great, like, clickbaity type of video, so there's probably not going to be a lot of views on it, but I thought it was important to at least show, you know, my dedicated viewers that, you know, this is what's going on with me, this is what's going on in my head, and this is the way I currently see, you know, what is the most rational way to be investing personally. So hope you guys got some use out of this. Let me know what you guys think in the comment section down below, and I will catch you guys in the next video. Peace.